I talk about opportunities and threats. I used to do a SWOT analysis, strengths, weaknesses, opportunities, threats in business plans. Take the opportunities and threats for a U.S. investor right now in this market, given the fact that everything looks pretty good.
Yeah, absolutely. Look, it's been a phenomenal market, really, in many ways across asset classes. In our view, that's been driven by two key themes this year. The first theme is clearly this rotation we're seeing, at least in the equity space, from growth into the more value-oriented sectors, at least on a year-to-date basis. And really since November of last year, keep in mind, last November, we saw presidential elections, we saw the approval of our first vaccines. And when you look at sectors like energy, financials, industrials, up nearly 70%, 40%, and 30% plus since that time. The second theme, of course, is this rise in rates. The 10-year has gone from 0.91, now 165, also supportive of some of those value sectors and putting a little bit pressure on the growth sectors. For us, the opportunity really is we do see a continuation of the reopening trade. We think there's at least one last leg to go. And that really, the highest conviction areas that we like there do include those that are levered to higher rates. We think, yields could continue to grind higher, maybe a little bit choppy now, but we see a two-handle on the 10-year at some point. In that environment, we think financials continue to do well. Certainly, yield curve plays continue to do well, such as steepeners. The reopening, the true reopening of the U.S. economy, we think those, the areas that do well in that environment are those that are levered to better earnings growth, like leisure, travel, think your true reopening sectors. And the final bucket we put in that, the opportunities, is really those that are levered to the new policy agenda we're seeing. So parts of the infrastructure market, parts of 5G and cybersecurity that are being lumped into infrastructure now. Now, just quickly on the threats, as we are heading to the second half of this year, we certainly are seeing some headwinds emerge. First and foremost, we will at some point hit peak reopening growth here in the U.S., probably in 2Q or 3Q of this year. We will have, the highest growth rates we've seen probably in over a decade. Secondly, we are seeing, as we noted earlier, yields continue to grind higher, driven by, of course, reopening, but also potentially inflation. And, thirdly, I think we are looking at a Fed that at some point, David, will have to come off of this crisis level accommodation. They said in the last press conference, it's when they see it in the data, not in the forecast. Well, that data is certainly going to come to fruition in the next couple of quarters. So keep in mind, we've had a great first half thus far. We might see another leg higher in this value rotation, but at some point we will consolidate those gains. Maybe it's seasonal, maybe it's sell in May and go away, maybe not in May this year, but a little bit further out. But just keep in mind those headwinds in the second half of this year may start to emerge.
Afsaneh, Mona really took us right into your backyard, or at least part of your backyard, when she talked about investments leveraged to policy, because you for a long time have talked about climate and green investing, Afsaneh. You've been a champion of that. We certainly heard about the infrastructure plan, $2.25 trillion, a lot of it directed toward climate issues. That's an opportunity. At the same time, do you need to be a bit of a stock picker, if you can say that, within that realm? Not all climate projects are created equal, I assume.
You're absolutely right, David, and I very much agree with everything Mona said. I think added to what she said on the infrastructure side that you just mentioned, whether it ends up being 2.25 or 1.9 or 1.6 or somewhere in between, those numbers are quite huge. And even if they get spent, some of them more quickly, some of them over time, they're going to have a more growth-oriented kind of impact on the overall economy. And what we're seeing as we're sitting here today is unbelievable amount of investments that are going into that intersection of innovation with EV, innovation with tech, with medicine, innovation with some of the other trends that we've talked about, but in particular, climate-related investments. So I think all of them will be also impacting markets in a very positive way, sort of looking longer term. I agree with Mona, though, that we will have some short-term corrections because interest rates are historically low. Even if we had the kind of bond markets, particularly at the long end that we've had this year, we have been historically at a very, very low level of interest rate, and people have got very used to that. Those of us who've been around a few cycles know that it will not last like this, and there will be some sort of impact as inflation picks up even for a short time. And goes back to lower levels over longer time.
Mona, one of the things that we're reading about now is perhaps some risk coming from the divergence we're seeing. The United States is really going ahead full steam with vaccinations. China, if anything, doing better than we are on dealing with the COVID-19. Europe, not so much, and goodness knows parts of the lower and middle income countries are lagging behind, Mona. Is that simply opportunity for U.S. investors, or is there also some risk if the U.S. gets too far ahead of the rest of the world?
Yeah, absolutely. You know, one of the themes that we're seeing emerge again this year is this return to U.S., what we're calling exceptionalism. Certainly, we have been ahead of Europe, as you noted, in terms of the vaccine rollout, and really setting up nicely for a strong set of summer months ahead of us. We're seeing this play out in the markets as well. The U.S. dollar, many expected to come into the year continuing to be weak. In fact, we've seen stabilization and even an upward trend. The dollar index is now up about 3% year to date. Similarly, in equity indices, you know, the S&P is now back at the top of the pack. Clearly, there could be a catch-up trade, and it's one thing we're thinking about now, especially as the U.S. markets have run. There could be a catch-up trade from Europe to be had here. You know, if they are lagging just a few months behind us in this vaccine rollout, we could see a real reopening of their economies in maybe another quarter or two.
Afsaneh, Mona says that we may be a few months ahead of Europe. We're a lot more than that when it comes to low and middle income countries. And that's true both with respect to vaccines and also with respect to the economies right now. We've had the IMF meetings. I know you've participated in them this week. A big topic of conversation. Give us a sense from your point of view of where we are in some of the more struggling nations around the world.
In some emerging markets, particularly the low income group, more than 20 years of growth that is potentially lost. And a lot of the numbers we're seeing, let's say the IMF, I think the IMF has really jumped ahead. And we heard about the 650 billion SDR package that was just agreed to, plus another 30 billion that IMF has put out for the pandemic window. Those are huge numbers, but we have to realize that, let's say out of that 650 billion, only 21 billion will go to the lowest income of those countries. And as we just said, in Africa, probably even by the end of this year, less than 5% of the population will be vaccinated. So putting this all together, as Janet Yellen said, I think it was this week, economic policy and COVID policy really go hand in hand.